Hello and welcome to another Hola Prime Academy video. This is Chris Lewis, your instructor, and in this video I'll be taking a look at interest rates and their influence on currencies. However, one thing that I would point out, there is a huge caveat because a lot of retail traders make the mistake of thinking that if the Federal Reserve has set interest rates at 4.25%, for example, that would be the end of the story. The reality is that the bond market sets the rates. And if that's the case, you need to keep an eye on those yields because it can tell you what would happen with, in this case, the US dollar. Every country has a bond on Earth pretty much, and therefore you need to pay attention to the various ones that you are trading. For example, the US dollar obviously is influenced heavily by the 10-year yield in America, but the euro is heavily influenced by the 10-year yield in Germany and to a lesser extent, France. The United Kingdom obviously has its own bond market, the gilts. That will have a major influence on the British pound. And then, of course, you have other countries like Canada, New Zealand, Australia that all have interest rates that move throughout the day via the markets and specifically their respective bond markets. So with that, let's take a look at some charts. In front of you, I have the 10-year 1-week interest rate chart. This is not the bond price. This is the actual interest rate. And as you can see, over the last couple of weeks, it has risen. That's interesting because here in the United States, the Federal Reserve recently had cut rates and people started trading accordingly. But the bond market has been in some revolt since then, and rates have only rallied. Without going into the mechanics of the bond market, because that in and of itself could be a masterclass, the whole idea is that higher rates will, generally speaking, attract more money into that country via the bond market. Think of it this way. If you are a Japanese investor and you've got a few $1,000,000 that you have to send somewhere to sit quietly, and rates in the United States are 4% more than they are in Japan, it makes a lot of sense that you put your money in the United States. You have to buy US dollars in order to make that happen. So specifically speaking, you would talk about US dollar rising against Japanese yen. But in this video, we're going to look at the specific currency. So I will add the US dollar index on a new price scale, and you will see it pop up on the chart. And you'll notice that as the yields rise, that has a very positive correlation to the US dollar index itself. Notice that we have gone straight up in the air recently, going from 100 to about 104 over the last month, while rates have gone from about 3.67 to roughly 4.26. This suggests that the US dollar should be strengthening against most currencies, but it doesn't have to just be the US dollar you look at. For example, Germany 10-year bond yields. Okay, so that would be the candlesticks. You can see what's going on there. And I will take the US dollar index out of it, and I will look for Euro currency index. Now, TradingView has the ease of function with this. You can do it with pretty much any currency, and the Euro currency index is going to be much like the US dollar index. It just basically measures the strength or weakness of the euro against multiple other currencies. So we have this, and notice this. There is a pretty significant correlation most of the time. You can also look at other ones. So for example, the French, and again, very similar price action most of the time. Now, there are other things that can move a currency. For example, in this case here, when we saw the euro drop, at the same time, the yields in America were rising, but they were rising much quicker. So that does have an influence. So you have to keep in mind, this is just part of the puzzle here. So let's do Canada 10-year yield. So there we go. And then we will change to CXY, which is Canadian dollar index. Add trading view and get rid of the euro. And you will notice, again, typically it tries to stick with it. This is that same time frame where we had massive US dollar strength. So sometimes it doesn't line up perfectly, but you'll notice since then it's been pretty straightforward. This, of course, is the weekly time frame. You can do it on the daily or even the hourly if you choose. It's a little difficult to do on the hourly, but it can give you a little bit of heads up. And finally, let's take a look at the British 10-year yield. This is on the daily chart. You can see that on the hourly chart, it does get a little bit messy for short-term traders, but daily, it's fairly steady. Let's take a look at the British currency index. You can see, apart from this area here, and I happen to know for a fact that was a very specific US dollar event, you basically see the market try to find equilibrium as the British pound follows yields. This is generally going to be the case most of the time, and it is something that you need to be paying attention to. Money goes to where it's treated the best, and what I mean by that is typically where you get more yield. Yield is a huge part of the investing landscape that must be paid close attention to, and therefore you are foolish if you are trying to trade without understanding that. Now, that's not to say that the interest rate yield itself is the sole reason to buy the British pound or the Mexican peso or whatever, but it does add to the puzzle pieces that eventually tells you what you should be doing. This is not something that you should ever ignore. If you see yields rising in a currency, then you start to think, okay, is that currency rising or falling against this other one? You look at the other currency and you see if those yields are falling at the same time, then typically currency A will rise against currency B, assuming that there isn't some external factor, geopolitics, global slowdown, that kind of thing affecting things. But for the most part, day to day, this does hold true of the longer term.